Code 3 Americans, and about the time it takes you to brush your teeth, I'm going to explain 3 key concepts you need to understand about the bond market and why it creates so much volatility and why we're always saying you need to be watching the bond market, not the stock market. First key concept, you have to understand bonds are simply debt. Somebody issues a bond at a fixed interest rate, and somebody agrees to pay back that money with a predetermined amount of interest. And this is a chart on the Wall Street Journal showing that bonds, these are U.S. Treasuries, have been low for a long time. So if you look at a 2-year Treasury, you'll notice during the illness, they fell. They've been extremely low. You'll see just about 22 basis points here, so way under 0.5%. And all of a sudden now they're up about 4.5%. You can see that through a number of other shorter bills. The point to understand is interest rates on these bonds have risen a bunch. Then what you got to understand is this is then, let's just say for this example, whenever then is in the past, bonds, somebody could buy a $100 bond for a 2% yield. That's the interest rate. This simply means that somebody's going to get $2 on their $100 in return. Now, with higher interest rates, somebody can buy that same $100 bond, but it yields 4%, meaning they get $4 on their $100 investment. So nobody would want this when they can have this. What that creates is if the bond is being held as collateral, as indicated here, people may have made loans, institutions made loans, they do it all the time, and the bonds are put up, say Treasuries are put up as collateral to secure the loan, much like if you get a vehicle loan, you have to put up some sort of collateral in case you default. So if somebody wants to buy a bond today, they're not going to go buy the $2 yield. They're going to want the $4 yield, assuming they can get 4%. Problem with that is to get 4% out of this old bond, you must cut your rate, or you must cut the bond value. You have to sell it at a haircut, and in this case, $50 for easy math. $2 divided by 4% is $50. That means the bond is now worth $50, not the original $100. That's important because if the bond was pledged as collateral, the lender is going to issue a margin call of $50 because they said, we'll loan you $100 in cash if you put up $100 in collateral, for this simple example. That's a problem if you're an entity that's already short on cash or collateral. So what's this do? It creates lack of confidence and volatility, and that just sits there and recirculates. And if somebody holding a bond that was issued in lower interest rates, which has been a bunch of them, they're going to have to reduce the value of those bonds to hit the same 4% to get the same $4 return, or nobody would want to buy them in the market. This is happening a bunch in the market. A lot of bonds were issued as collateral, and now there's not, or now there's margin calls where different entities that lent that money are saying, hey, you don't have enough collateral to secure your loan. You need to bring more. That's why it's so important to watch the bond market and the debt markets to understand what's coming. And that's why one of the reasons it creates volatility. The other reason it moves money out of Wall Street is the higher this number gets right here, the more people can earn. And if they can start to hit closer to inflation rates, it what should be safer investments. U.S. Treasury is supposed to be the risk-free alternative. They would be less apt to go out on the risk curve and go into the stock market. That means money migrates from equities in the stock market over to the bond market, because finally they can start to get some higher yields. So that's what's going on in the bond market. That's why it's so important to understand that you need to be watching the bond market, not just the stock market. And hope to see you on the next video.